Hello and welcome to Just Retirement's first webinar. I'm Mark Colgate, I'm your host for today, and I'm going to introduce you to Steve Martell, Development Director at Just Retirement, in a moment. But just before I do, I'd like to just go through a couple of housekeeping rules on today's event. It is going to be about 30 minutes long. Steve's going to speak for 20 minutes, and then we'll have 10 minutes left over then for questions. And you can see from the screen in front of you that you've got the facility to send in, email in questions, and we'll endeavour to get those answered in the last 10 minutes of today's webinar. So without any further ado, let me hand you over to Steve Martell. Steve, tell us a little bit about what you're looking to cover today.
Well, yes, good afternoon, everyone. We're really pleased to have the opportunity to cover some key areas today in our very first live webinar. We're going to start by looking at some of the key factors affecting the at-retirement market at present, including the EU Gender Directive, Solvency II, and the changes in the Finance Bill. Then we'll move on to look at the implications for the drawdown review process and the opportunities within flexible drawdown. After this, we'll run through some of the new planning tools and resources that we've got available on the justadvisor.com website. At the end of the session, as Mark said, there will be an opportunity for you to ask questions. We will deal with as many of these as we can and come back to anyone who raises a question that we don't get to cover. So please, as questions occur to you, send them through to us using the link on your screen.
Steve, thanks for that. Now, let's get straight into the agenda there. There's been a lot in the press about this EU judgment on the Gender Directive. What's your take on it?
Well, yes, it's a subject that has taken up quite a few column inches. But although the industry has been aware of the ruling for a while, full details of the required changes that will come into force in December 2012 are not yet available. Whilst now isn't the time to debate the rights or wrongs of this approach to insurance pricing, it does raise some interesting issues. Perhaps not all would agree with the comments of the Belgian consumer group about what a victory this has been, and it will be interesting to see if there are any challenges to this judgment before it becomes effective. So, what are the issues? Whilst there's been plenty of debate about the impact of the EU Gender Directive, actually there is very little certainty around how the principles will be implemented or enforced, and in particular the impact that it may have on business written between 2007 and 2012. The ruling from the European Court of Justice on the 1st of March now needs to be turned into legislation, which will likely be an amendment to the Equality Act following an updated European Commission directive. The European Commission itself is liaising with the Treasury and its equivalent in other markets. The Treasury is in turn liaising with the ABI and so on. Let's look at some of the challenges that we're facing. Firstly, the uncertainties remaining need to be clarified, which is expected to take a few months yet. If the industry goes on and moves on to an underwriting business basis based on actuarial factors rather than gender, what factors will they use instead? Will men be able to challenge non-preferential rates on the grounds that they should have had different terms as men have a shorter life expectancy? And what about the effect on rates? Well, some will go up and some will go down. For example, a healthy male. Rates will also vary by health, age, and other actuarial considerations that will replace gender. For example, occupation. Certainly for enhanced annuities, there will not be a simple X% rise for some and Y% fall for others. And last but not least, let's look at the positive impact. The move to fully underwritten annuities will help identify clients who can benefit from health conditions with an enhanced rate. It will become even more important to consider health first. Tom McPhail made the point recently that this is a really seismic event and one that should encourage every investor to shop around for the best deal for them at retirement. A very important part of this will be to factor in their health position and lifestyle to ensure they can use this to benefit their retirement income.
Well, thank you for that, Steve. There's lots been written about Solvency II as well. It's a major consideration for everyone. What's the latest on it? What's your uptake from the perspective of Just Retirement?
Yes, the new Solvency II regime coming in on the 1st of January 2013 is a pan-European initiative which will standardise the regulations on capital requirements of insurance companies across Europe. Following its implementation, capital requirement will be determined by risk, a company's awareness of and controls in place for the risks that their business faces. For companies that are able to recognise their business risks and have controls in place to mitigate these, it could mean that they will need relatively less capital in the future. However, it could also mean that companies who don't have appropriate controls may have to put aside relatively greater amounts of capital. The problem is that we don't yet know the final shape of the requirements or the effect this will have on annuity rates. Coming up with any single measure of the effect on rates would be no more than speculation at this point. Because of this, it's important to focus on what we do know.
What do we know?
Well, let's explore what drives annuity pricing. There are many key factors that affect annuity pricing, and some of these are related to Solvency II. For example, Solvency II creates a new set of capital requirements and the EU Gender Directive. The future for annuities is hard to predict and is a very big issue for pensioners and advisors alike. The list here shows the main factors that drive rates in a normal environment alongside the legislative and regulatory factors that we've covered. Everyone will be aware that the longer an annuity needs to be paid out, the lower the income payments will be. By underwriting, it means that and by underwriting someone in a particular way, it means you can accurately determine the expected duration of the payment, and so you can provide higher annuities to those with lower life expectancy due to health or lifestyle. It's a heads you win, tails you don't lose approach to income planning, as there is absolutely no downside in going through the underwriting. Because of this, it's a crucial exercise to undertake for everyone at the point of retirement. Let's not lose sight of the fact that the majority, up to 60% of people, might now qualify for an enhanced annuity.
But what about investment returns as a factor in annuity rates?
Yes, that's right. They are important. The assets that back the annuity payments have a big impact on the annuity rate. Annuities can be expected to last, in some cases, up to 40 years. Annuities are backed in part by bonds, and bonds of a long duration are in short supply and so are expensive. Bond yields have a big effect on annuity rates, and corporate bond yields are greater than gilt yields generally, but more volatile, especially in recent years. It's the volatility of bond yield which causes the volatility in annuity rates.
So putting all this together, what does it mean for annuity rates then?
Well, the conclusion is that short to medium term, annuity rates may go up, they may go down, or they may stay about the same. I know that does sound a bit like a politician's answer, but it's a really important thing to consider as part of the income planning process. In the same way as you can't predict the stock markets, you equally can't predict annuity rates. And so your clients need to be aware of this when making decisions. No one has any control over this. One thing you can control, though, is the decision to assess a client's eligibility for an enhanced rate by spending just a few minutes asking them some health questions.
Well, let's move on to the drawdown regime. There have been some recent changes there. What do you feel the opportunities are now for advisors?
The revised drawdown regime has been widely awaited and has brought some very good news and some disappointments. The good news is HMRC have recognised that not every 75-year-old wants to exit drawdown. PCLS can now be taken at any age from 55. Flexible drawdown has arrived. Death benefit taxation has reduced by a third for those aged over 75. And value protection has been extended beyond age 75. The not so good news is maximum withdrawals are much lower and closer to annuity rates for cap drawdown. The tax charge on death benefits for those entering drawdown or already in drawdown in their younger prime time retirement years where they are under 75 is now 57% greater, i.e. it's gone from 35% to 55%. The tax charge on value protection has also increased, and those affected were unlikely to get higher rate tax relief.
So what effect do you think these changes are going to have on the drawdown review process?
The fact we're 5 years on from A-Day, and over this time there have been significant changes within the industry, means now is a fundamental time to take stock with a fresh look at evolving the drawdown review process. Some changes will have a positive impact, such as flexible drawdown, and the improvements for those aged over 75. But there is a balancing effect of an increase in the tax charge on death before age 75 by 57%, as we've already mentioned. This is a bitter pill for the 60-year-old entering drawdown for the first time, or the client in their 60s who has been in drawdown for a while. There's also the increasing onset of poor health as clients in drawdown become older, which may mean an enhanced, more secure income can be gained from an enhanced annuity and should be considered as part of retirement income planning. Perhaps most important of all is what some are referring to as the triple whammy.
Now that sounds a little ominous. Talk us through the triple whammy.
Well, since A-Day, we've seen continued investment market volatility manifesting itself in sustained periods of low interest rates and fixed interest yields, and a wildly fluctuating set of stock markets. War, civil unrest, and the tragedy of natural disasters don't help this. To add to this, the new drawdown regime brings with it a reduction in the maximum income for most people in drawdown in the most active earlier years of their retirement, and a significant increase in death benefit taxation during this time period. Whilst this triple whammy may have a greater or lesser impact on your clients as a result of their personal circumstances, it should have an effect on the advisor's drawdown review process.
Well, so what are the key questions that advisors should be asking in relation to that drawdown review process, Steve?
Well, firstly, what does our current drawdown review process look like? How do we charge for the services we provide, and are they profitable to us? How frequently do we review our existing clients' drawdown plans? Do we need to change the frequency of reviews? How soon after the 6th of April should we be reviewing our clients' drawdown plans in light of the changes? Are there any clients who require reviews more urgently than others? And how do we identify them? Which events should trigger an ad hoc review of our clients' drawdown plans? Are there any clients currently in drawdown who we believe should consider alternative retirement income solutions? And indeed, are there any clients who no longer have an appetite for investment risk and are seeking alternative income solutions?
And what about client segmentation? How should IFAs go about segmenting drawdown clients? I mean, after all, they're not all the same.
Well, a segmentation model could comprise of clients who want to consider and are eligible for flexible drawdown, those aged over 75 who want to pass more capital to the next generation and who may want to reduce their income levels, the under 75s who may want to adjust their investment strategy now that they're able to plan over a longer time period within one single drawdown regime, i.e. the investment time frame may now be considerably longer. Those who want to capitalise on the value of their pension fund and exchange some or all of the capital control for a guaranteed lifetime income. Clients eligible for enhanced levels of income where the degrees of enhancement may directly affect their financial planning objectives. An income level that is enhanced by, for example, 20% and guaranteed for life may be something that they will want to consider as part of an overall income portfolio. And people in their senior retirement years who may now be actively seeking annuitisation through an enhanced or a standard route. All of these people may have different needs.
Well, that's the segmentation model, but are there any other issues that advisors need to consider?
Well, yes. How do we evidence treating customers fairly in our drawdown advice process? What rate and shape of investment return is required in order to secure an income level that matches the level that they may be able to obtain from an annuity? Is this rate and shape of return something I'm comfortable with seeking for the client? Does the client understand the implications of achieving a different rate and shape of investment return? Do my clients know what I know? And if not, how much of this knowledge do I want to share with them? Will this education process affect their future income planning objectives?
Certainly a niche that Just Retirement's carved out for itself is helping to put clients' health right at the top of the planning agenda. What sort of effect can this have on clients who are already in drawdown?
Whilst a large number of clients in drawdown will be relatively healthy, many may qualify for enhanced annuities. Evidence suggests that the majority of clients might qualify. Our research suggests this may be as high as 60%. So it's important to avoid falling into the trap of thinking that all wealthier clients are really healthy and therefore won't qualify for an enhanced income. Clients eligible for an enhanced annuity may find the degree of enhancement could directly affect their financial planning objectives. For example, an income level that is enhanced by 10 to 20% and guaranteed for life could be appropriate as all or part of an overall income portfolio, whereas a non-enhanced income may not be so appropriate or attractive. In this example, the GAD maximum and standard annuity rate are close, but the enhanced rate is 15% higher, resulting in £1,000 per annum more income for the 65-year-old. If your client qualifies for an enhanced annuity, there may be the need to reassess their investment planning timeframe, as their potential capacity for investment risk may vary according to their life expectancy and individual circumstances. A shorter life expectancy may mean a lower capacity for risk, for example, but it depends very much on each individual client. What's more, being able to secure a guaranteed income that could be up to 40% or more above the level of a standard annuity for a more serious condition does affect the way people view their desire to retain full control of their capital. Sometimes the key issue becomes more about income than capital preservation. As a result, an enhanced annuity may be something that can be considered either as a full or part solution for future income needs. Many people are now building in as part of their overall strategy.
Well, I can see the logic in this, but how long does it take to go about doing this properly?
Well, the answer is not very long at all. There are two simple steps to take to build this into your drawdown review process. First, assume that everyone qualifies until proven otherwise. We estimate that 60% of people might qualify for an enhanced annuity. The only way of knowing if you're one of them is to fill in a medical underwriting form with all your medical history and lifestyle details and obtain a quotation. We have underwritten over 1,500 medical or lifestyle conditions, alone or in combination, which have resulted in an enhanced rate being offered. There are some positive indicators to look for, such as smoking. And did you know that 2 pints of Stella a day can qualify you for an enhanced annuity? Second, delve further and spend just 15 minutes looking at their health in a little more detail by filling in the common quotation form. This could be the most important 15 minutes of their retirement.
Well, just before we leave the subject of drawdown, can you give us your thoughts on flexible drawdown?
This is a great planning device for those with sufficient secure pension income. We're showing an example here of a client with a fund of £500,000 who wants to maximise his use of flexible drawdown. I'm assuming the $20,000 of secure income required comes from an annuity and the basic state pension, but for simplicity, excluding other pensions such as a final salary scheme. If the client annuitises, he may need $223,000 of this to provide him with the £14,688 per annum of secure income required once the basic state pension has been accounted for. But this can drop to £202,261, i.e. by around 10% in this example, if he's eligible for an enhanced annuity, giving him an extra £21,000 for flexible drawdown. Obviously, the cost of an enhanced annuity could be lower, depending on the seriousness of the conditions. Overall, the message has to be, it's a great way of increasing flexibility, and always make sure that for the annuity you purchase that you consider an enhanced annuity.
And what sort of new planning tools have you put on your website to help advisors with just these scenarios?
Well, there's a whole series of resources and planning tools for you to use in relation to the retirement income planning process. There are calculators and resources that look at the drawdown review process in more detail, together with a short film that summarises the issues and opportunities for advisors 5 years on from A-Day. It's also worth mentioning that we're running some more roadshows in June and July, where we'll be covering the issues in more detail. Just log on to justadvice.com for details.
Steve Martell, thank you very much indeed for that and for covering so much ground. Now, we have got about 10 minutes for questions, so whilst you're thinking of your questions to ask Steve, Steve, I wonder if I could come to you. You were mentioning in your talk there that something like 60% of people could be eligible for an enhanced annuity. It seems an awfully high figure, doesn't it?
Yes, we undertook a major research project last year looking at the incidence of health conditions and the probability of having these conditions at various ages. When you combine this with other qualifying criteria, it produces a very high probability of qualification. We have underwritten on more than 1,500 conditions and can underwrite on even more, so we're very thorough. As long as we get an underwriting questionnaire, that is.
How do you encourage more people to use their open market option? I think the last sort of stats I saw suggested only about a third of those eligible to do so
should do so. Yes, it's a real frustration, isn't it? It's one of the reasons why we've been campaigning for the open market option since we launched, and why we set up the campaign for better annuities. Recently, the Pensions Income Choice Association was set up, or PICA for short, to encourage a system where the person retiring needs to do something rather than automatically defaulting into an annuity from the holding provider that may offer a much lower rate than they could receive in the open market. We are members of PICA and are keen to help drive change in this area, especially at a time when people are facing much lower annuity rates than they may have anticipated.
But are annuities really a case where you're either a winner or you certainly can't be a loser? I mean, if everybody takes advantage of the open market option, presumably rates will go down, won't they?
Well, I think there are many balancing factors as we've talked about here, in that it relies on so many factors, that your health being the most important factor of the lot. The key criteria for people to focus in on is not just what the other factors are, but their own personal health situation, because this will drive the rate more than anything else.
Now, I want to pick up as well on Solvency II. I mean, how do you go about preparing for an event like this? You said there's so much uncertainty. What do you just sort of leave the dust to settle for 6 months or a year, or are there things you can be doing now?
Well, we've had a big team of people working on our Solvency II project. There are around 80 people working on this project, making sure that we're ready to meet the requirements. It's important that insurers give this a real priority in their business, and we're all well prepared for it.
And when do we start to get some certainty on it? I mean, are there kind of key dates that will be coming out from Europe on this?
The Solvency II, because there is so much time between now and when the final rules become implemented, that things will come through gradually. The project team will be working on it. The closer we get to it, the more clarity we have, the more we can then be clear as to what the requirements are.
Another thing, you were mentioning annuities there. Are you starting to back annuities with things other than government bonds?
Always.
Seeing as the trends in the market.
Traditionally, within the portfolio that we offer, there are a large number of corporate bonds that back annuities. It's not just government bonds, it is corporate bonds as well. So it's standard practice for providers to use corporate bonds as well. They tend to offer better yields, particularly when they're of a blue chip nature. It's a sensible, well-practiced business principle that people use to back annuities.
I have a question in from Darren Smith. He says, I'd like to know if you have any statistics that can demonstrate what percentage of retirees take their annuity on a clean life basis only to then develop a health issue when they might otherwise have received an enhanced rating. This is more applicable perhaps for temporary annuities or even drawdown/third way cases, which might then convert into enhanced on a future review. I hope this makes sense.
Yes, it does, Darren. That's a really good question. Thanks for that one. We are, in fact, as we speak, working on some data on this at the moment, in that we have masses and masses of data of health conditions at various points in time. So what you're describing is people's fading health. It is such a major issue because so many people, when they purchase annuities, according to our stats, around 40% are going to be healthy and not eligible for an enhanced annuity. But a large number of those, 5-10 years down the line, won't be so healthy. Their health will have faded, and the chances are they will qualify for some degree of enhancement. And my response really, Darren, is watch this space. We will come back to you about that with some more details as soon as those final calculations of that research are available.
So just while on the topic of annuities, we keep getting headlines that inflation keeps going up. It keeps coming in above 4% at the moment. If you're an advisor looking at that, what can you do to inflation-proof your clients' annuity?
Well, you can pre-select levels of escalation on an annuity. The dilemma for people is whether they get value out of that. Whether they'll view inflation quite differently in 10 years' time, you only know with the benefit of hindsight. And certainly it is one of those things that has been off many people's radar for a long period of time because inflation's been relatively low. But when we get headline events of inflation dropping to 4%, as announced today, it really does highlight that inflation is much more of an issue now.
Moving on to drawdown reviews, you covered a lot of material there, but have you got a simple guide to a lot of these issues? Is there something you've got there that can help advisors?
Yes, there's a document on our justadvisor.com website in the Finance Bill section under Resources and Tools. This captures all the key issues we've discussed today and the issues that we need to think about.
And what are the chances of being able to produce something like an advice tool, I suppose, which allows people to work out whether their client should be in drawdown or buying an annuity, or what are these sort of third-way annuities that people are talking about?
Well, we're working on something at the moment to help show the journey people in drawdown may have experienced and what type of income they expect going forward. This captures the point that risk does look very different when you're in retirement and taking an income in the last third of your life. We hope to have something available in the next few weeks, so just keep checking back on justadvisor.com.
When we were talking about, you were talking about the drawdown review, you were saying there was an end to compulsory annuitisation at 75. Could that be a bit of a burden for advisors? I mean, do you have to go through a lot more paperwork to prove that your client really should be in drawdown at 76, 77, 78?
Well, it's an interesting point, isn't it? I think the thing about drawdown reviews and suitability for drawdown is that one client's suitability may be completely different from another client's suitability. And I think perhaps what our research in this area has indicated is the need to undertake thorough drawdown reviews on a very regular basis, particularly when people's circumstances change. So that may mean ad hoc reviews and programmed regular reviews. And whilst doing that, making sure that everything gets reviewed, including the need to include medical conditions and whether they would now qualify for some degree of enhanced annuity as well.
I was going to say, you're talking a lot about putting health data at the forefront of what you do, but it can be pretty tough to collect health data, isn't it? I mean, how do you speed up the collection of that and the underwriting of that?
This is always an interesting one. In the immediate future, perhaps the easiest way to speed it up is to get as familiar as possible with the underwriting questionnaire. Advisors that use the common quotation form routinely tell us that it doesn't take long to complete, so not all the sections will apply. It probably takes no more than 15 minutes. So to put this in context, if you have a client taking an income of £15,000 per annum from an annuity or a drawdown plan, and the underwriting justifies an uplift of 15%, if they live for just 15 years, this will be worth more than £30,000 to them, or the equivalent of £2,000 per minute spent filling in the form.
Steve, we've got a couple of minutes left. I've got time, I think, so just one more question I think I can squeeze in from Mark Burkitt of Austin Burkitt. He says, do you see fewer providers being in the retirement market in the future, given the changes that we're seeing?
Well, that's a very interesting question, that one, Mark, because this market is like to grow so much. The latest figures from indicate that the market will be in the region of 23 billion by 2013, whereas the market in the last 12 months or so has probably been around about half of that level. So a lot of providers are likely to want to be the beneficiaries of retirement income planning. What does that mean in terms of annuity providers and retirement income providers? Difficult to say, but one thing's for certain, that the continued need for innovation and the continued need for people offering better solutions for longer-term retirement income solutions is going to get greater and greater. That must mean that there must be more potential for more providers in this market and a lot more product development. But a really good question, that one, Mark.
Squeeze one more in very, very quickly. You've made a point about the need for capital control and how that can shift towards more of an income priority. How do you see annuities offering good value at a time when the yields are so low?
Well, an annuity will always offer a level of value because of the certainty of income it provides. Whether rates at the point you set up the annuity are good value in comparison with other time periods can only really be judged with the benefit of hindsight. If you need income, you need income. If it becomes possible to increase your income by, say, 20% because of your personal situation, this represents such a significant uplift that it may be sensible to make sense to take the higher income and forego some capital control. People can do this by either fully or partly choosing to annuitise. It doesn't have to be an all or nothing decision.
Okay. Another very quick question in here. It says, you mentioned the fact that 2 pints of Stella might mean you could get yourself an enhanced annuity for your client could. Got any other list of minor issues that might qualify clients? Something that advisors can use with their clients to really make them sit up and think?
Well, smoking is a common one that often gets quoted. There are also many, many classes of occupation that would qualify you for an enhancement. The message is never ever assume that a client that looks healthy won't qualify for an enhanced annuity, because the chances are there's a 6 in 10 probability that they probably will.
Steve Martell, we are pretty much out of time. Thank you very much for being with us today. Thank you very much indeed for listening and for sending in your questions. I do hope that there was some content there that you can use in your business.